Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what we talk about? Well, I'm going to continue with the methodology and action. As you know, we've been doing a series on my next 100 trades, warts and all. We have a mystery chart for this week and follow up with some prior mystery charts. And in the meantime, or in the process, I should say, I'm going to talk a little bit about stock picking, money management, and some other trading concepts. For the Mind the Trade segment, I want to talk about how markets really work. And then last couple of weeks, I left you with one question. That question continues, but I'm going to give you two questions to add to that. And that'll make a lot of sense in just a little while. Housekeeping, I do take a request. It makes my job a lot easier knowing what I'm going to cover ahead of time. You can send those to davelandry.com/contact. If I can't fit it into this venue, I do a weekly show every Thursday night. davelandry.com/webinar to register. Register even if the link is old. On Thursdays, I do have a link on my homepage to register, so you could also register there. Register once, and you're registered for all, unless I forget to add some shows in 6 or 8 months from now. But anyway, if you need to reach me on Twitter, there's my Twitter handle. All right, let's talk about the mystery charts and the methodology in action. As you know, I've been showing my next 100 trades. Just real quick, zero hindsight, and these are warts and all, and these are come directly from my trading service or possibly Facebook posts. But if I make a trading service recommendation, that counts towards my 100 trades. And if I make a Facebook post with a setup that I'm going to take, then that goes there too. I won't take anything ahead of time and then say, hey, look, I took this. And the reason I started this whole process, just an FYI, in case you're new to the show, is somebody called me out and said, I'm just showing winners. What about losers? Well, there's not a whole lot to do with a losing trade other than honor your stop. With a winning trade, you need to take partial profits. You might need to apply a little discretion. You need to trail a stop. There's a lot of things to do, and there's a lot more to teach when it comes to winning trades. Losing trades, you just need a little discipline, and you get stopped out, and you get stopped out. Anyway, I've showed a representative sample, and that representative sample will be based on so far roughly a 100K account, and that's what the trading service hypothetical portfolio and recommendations is based on, but I'm actually taking real trades here for this project. So here's a mystery chart reveal. This was a big picture cup and handle. It was crypto related, and as you know, crypto was doing better for a while, and then crypto kind of crashed. Anyway, there were the parameters: 585, 450, and 720. Entry, protective stop, and initial profit target, respectively, for a risk of $1.35. So this is what it looks like on a chart. And this is what happened. Notice that it did not trigger. Began to sell off fairly hard. Bounced a little bit today. Then started to come back in a little bit. Anyway, I took it off a couple days ago off of my recommendation list. And the reason I want to show you this is no capital was put into a harm's way. If you'd just jumped in on this trade as opposed to waiting for an entry, you would have got triggered in and likely would be losing money by now. It always amazes me how many bad trades can be avoided by simply waiting for an entry. As I've said 10 million times, I'll get an email from somebody like, hey, Dave, I'm in that turd you recommended, and I'm down half of my money on it, or down 50%. It's like, well, I didn't recommend that. That thing's going down, straight down for months. When did I recommend it? I'm like, wow, 6 months ago. And I'll go back 6 months, and sure as heck, I recommended it, but it never did trigger an entry. And I don't know how much I'd bet on it, but I'd be willing to bet maybe 6 months from now somebody's going to email me about iron, and it's going to be down at $1.99 or whatever, and want to know what to do. Waiting for entries can often keep you out of trouble. So here's our new mystery chart for this week. There are the parameters down there. You can see entry of 1785, stop at 1410, IPT at 2160. Longer term, it's a big picture cup and handle. I'm a big fan of the cup and handle pattern. I like when stocks bottom out, begin to rally. I don't necessarily buy directly off the cup and handle or any other big picture technical analysis type of pattern. But what I will do is if there's a bow tie, which I think this one was, or a first thrust, and that's when a stock makes a major low, ideally an all-time low, has a big thrust from lows and then pulls back, I'll take those type of setups. So anyway, that's the entry, that's the stop, and that's the IPT. So far, no trigger. If it goes a few more days without triggering, I'll likely take it off as an official recommendation, but for now it's still a live setup. Here's an update on one that triggered a couple of weeks ago. Those were the original parameters, as you can see: 3050, 2650, 3450, entry, protective stop, and IPT respectively. Nice thrusts. Notice the pullback, kind of a TKO type of setup, which I'm going to touch upon in just a few minutes. Entry was there, stops down here, IPT is up here. Now, as I said last week, I did take profits a little early on this one just because it took off on the first day, and I figured it was worthwhile. One thing I do have to be careful of, as I've been saying quite a bit, is to not let this project influence my trading and instead do what needs to be done. So, for instance, I don't want to take small profits just so I could show a profit each week. I want to make sure I'm taking profits at a proper level. Now, if I'm just a few cents off, or depending on the stock, or in this case, it might have been about a half a point or so, but the stock made such a big rally so fast in one day, it just seemed like a bit of a gift horse to me. So that's why I took profits a little bit early. And if you want to see the actual trades on these, go in and watch the prior shows. If you want to see the recommendations, DaveLeonard.com/archives, and you can see without any hindsight what I recommended the day before or days before they triggered. Anyway, let's follow up on Verve. Verve was another one of those setups. As you can see here, Verve had an entry of 26, protective stop of 18, and IPT of 34. And the reason that these stops are rising in the animation is because once the IPT is hit, we take off half of the shares and we move the stop to break even, and then we free roll, so to speak, on the remainder of the position. And as the position moves in our favor, meaning that it begins closing at new closing highs from where we entered, we begin to trail that stop higher. And as I've said quite a bit, we don't always trail it on a one-for-one basis. We allow that to gradually open up. That's once we hit the initial profit target and once we're to break even. As it makes new highs, we begin to trail that stop higher, but we let it open up in the process in an attempt to ride out longer-term trends. And I'll show you the portfolio right here. And you can see the idea, as I've said quite a bit, is to let that stop widen out and catch the occasional home run. Now remember, this is on a 100K account. I do have 1,000 shares of this in my model account, so to speak. So I am showing over 20K in open profits, along with, I'm knock on wood by the way, along with I think it was about $1,400 worth of dividends. First stock I think I've ever owned that had any meaningful dividends. But there's the open portfolio based on the core methodology. And again, if you want to see the actual trades here, you can go to DaveLeonard.com/archives, and that's completely free. And that's a great exercise, if I say so myself. Go in and see what I recommended. Go in and see what worked and learn from my stock picking, and then go and see what didn't work. And all the setups, I believe, are good-looking setups, and on every setup, I think has the potential to double, triple, or more. But obviously, quite often, I do get stopped out, but that's okay. I just dust myself off and say next. So how am I doing with this little 100 trade project? Well, not so good so far. Now, last week, we were in the hole about $436, or exactly $436. We did do better the week prior, but then we had a bit of a drawdown. Now, what I did initially was I was showing a lot of the trades that I'd thrown out up here. And like I said, if I throw out a trade, I will mention it here. But these were mentioned in the Facebook group. And then I decided I'm going to focus on the core methodology mostly, at least until we capture a few big winners, and knock on wood, maybe Verve, VERV, will turn into one of those big winners, which was a former mystery chart. So where are we this week? Well, we improved a little bit, and if you think about it, it's kind of shocking given the market tanked like it did. The Verve kind of hung in there for us, so that helped a little bit, but only 2 open positions out of those trades you're seeing here. And again, the idea, as I've talked about quite often, is to catch that occasional home run. And that's what makes the service work. And that's what makes my methodology work, and the methodology is mostly pullback related and the hybrid approach to money management, meaning that we're taking off half of those shares at the IPT, and as I mentioned earlier, letting it gradually widen out. Just some random thoughts I've been talking about quite a bit. I want to be careful not to let the observation thing affect the actual trades, and as I've been saying quite a bit, when the quantum physics people were able to look at the little particles, all of a sudden they started bouncing around in a weird way, and then they realized that the actual looking at them affected the particles, and I think that's the Heisenberg theory of quantum physics or something along those lines. So I need to be really careful not to take little profits just to show a profit. The old commodity adage comes to mind: don't eat like a bird and defecate like an elephant. That means take little tiny profits and then take really big, huge losses. A little discretion is okay, and that made more sense in prior presentations where I showed trades that I used a little discretion, such as the EDMC, where I took profits a little bit early. And then it also shows a definition of Einstein's insanity versus Churchill's definition of success. And if I'm following the core methodology and truly picking the best stocks and following my plan, then I know if I get stopped out on a trade, I'm one step closer to winning trades. And you have to be careful not to be Einstein's definition of insanity, which is doing the same thing over and over again and expecting a different outcome. And I did talk a lot about that, by the way, in last week's Dave Landry's The Week in Charts, and I put out some exercises for you to help from becoming Einstein's definition of insanity. If you go to youtube.com/c/Dave Landry and check out the Week in Charts playlist, you can check that out. The core methodology doesn't work all the time, but it works over time. So as soon as we nail a couple of big winners, or as soon as I nail a couple of big winners, then you're going to see this thing really pay off. Truth be told, as I said quite a bit a few Sunday nights ago, I'm laying in bed thinking, what the hell have I done? What if this doesn't work? But I feel confident it will work longer term, because that's the whole idea, is catching these occasional home runs. Now let's shift gears and talk about Mind the Trade. Now, as I said in the last couple of weeks, your life will spill over into your trading, and your trading will spill over into your life. Both good and bad, but it can create a negative feedback loop. If your life's going great, you might be a little too euphoric for trading, and if your trading's going great, you might feel pretty good about your life. And it could also really make a negative feedback loop, which is even more dangerous, obviously, if you're having trouble in your life, which we're all faced with a lot of little challenges. Then it could affect your trading, and if your trading is going poorly, it could affect your life. And as hard as I try, if my trading is going poorly, if I have a bad day, I go home in a bad mood, usually. Unless I really, really follow the plan, and I'm willing to say it happens. Now, one thing I've been talking about over the last couple of weeks is all of these things that go through your head when you're looking at a chart, all these things that are in your head when you're looking at a setup. And the question I posed was, what does this have to do with that? So on every trade you make, you need to ask yourself, what influences that have nothing to do with the trade could be influencing my decision? Along those lines, I told the long, boring story last week about the transformer test, and Reader's Digest on that is, I was just, somebody recently told me that, these kids nowadays, I'm sounding like an old fart, these kids nowadays, they don't know what Reader's Digest means. Reader's Digest is this little book which would have little stories in it, kind of like condensed little stories. But anyway, the story I told was I worked at a plant that made transformers, and it was a miserable part of my existence. And my job was tasked with writing some code, or fixing some code at least, to make this system work so they could make transformers and track their progress. And I would often have to call accounting, and instead of me getting their voicemail where I could leave a detailed message, One of the people in the surrounding department or surrounding departments would answer the phone, and it was a very inefficient thing to do. And one day I asked them, they were all sitting around having lunch, why do you guys answer each other's phones? And there's like, well, we all have kids in school, and what if a kid breaks an arm? And it's like, well, what does that have to do with making transformers? And parents don't like to hear that kind of answer. So I would suggest on every trade you put the transformer test to the trade. And one of the things I was writing about this morning in my morning pages is you're going to have these epiphanies over time. And one thing I kept documenting was that it seems like anytime I'd walk in the office, I'd make a new trade, and that trade would lose money on my intraday trading. I don't recommend doing a lot of intraday trading, but since I'm here all day, I do occasionally fire off a trade, especially on a day like today where the market's kind of tanking and I have a lot of long positions. I'm not trying to hedge them, by the way, but what I am doing is I see an opportunity, I'll short or I will buy inverse shares and I'll ride them for a while, maybe take some partial profits and trail the stop. And if the market continues to tank, at least I'll make some money on that. And that can kind of help to smooth out the equity curve with the other stuff. I know I didn't mean to get into that a little bit more advanced than I want to talk about today. But anyway, one thing that I learned, as I've said before, is I call it the walk in the office trade. Seems like a walk in the office, make a bad trade, because for some reason I'm all excited. And it took me a while to realize, but I was reading a book on behavioral science or finance, and they pointed out that judges gave far more lenient sentences based on a study they did after lunch than before lunch, because before lunch they were hangry and after lunch they were feeling good. And then it dawned on me the two times that I made those walk in the office trades that usually failed were after breakfast and after lunch. So technical analysis will unfold like a bit of an onion. The trading psychology will unfold in the same sort of way, and you have these little minor epiphanies. So now what I do when I walk in the office, I know I'm kind of digressing, but I'll write WITO in the time, and then any trades made around that time, I'll be really cognizant over the fact that, am I making this trade because I feel good? Kind of goes back to what we talked about earlier. What does this have to do with that? A few weeks back, I introduced the concept of technical analysis apologetics. Now, apologetics usually refers to theology with reasoned arguments or writings to justify. Now, I kind of like the idea of using that word for technical analysis. And here's the thing, no matter how long you've been at it, and this is one thing I learned from the American Association of Professional Technical Analysts, people like Tom McClellan give speeches which could be very much related to apologetics, and it just makes a lot of sense. We're really trading traders and not markets and not stocks and not crypto or whatever. We're trading the other traders. So along the lines of the apologetics, fundamentals are held hostage by price. Now, that's probably not an original thought. And that original thought, which I was trying to dig up out of Greg Morse's Investing with the Trend, it probably came from that book. But I think Greg at one point in there, and I couldn't find it, talked about the fact that all the fundamental theories, or any other theories for that matter, will only go as far as price will allow. So we're trading price and not the fundamentals. Now, you always get something good out of Greg. While looking for the quote I was thinking about, I found this, which I thought made a lot of sense. Technical analysis is the analysis of price. Price is what we buy when you buy a stock. You're not buying the earnings, the products, the management, dividends. You are buying the stock at a market-generated price. Those things might be why you buy it, but they are not what you are buying. You are buying the stock, not the company. Now, as I've said 10 million times, the only way to profit from a trade is to capture a trend. This was created many, many years before Greg wrote his book, or before I knew Greg. But the bottom line is, agreeing with Greg, or the same sort of logic, is you're buying the price, and the only way to make money off the trade is to sell at a higher price. So your profit, obviously, if you buy at A and sell at B, is B minus A. I know, Captain Obvious and implied. And the other thing I often talk about is technical analysis leads the way. If a market's going to go from A to C and B is somewhere in between, other than occasionally with IPOs, you can't just blindly buy at B, but you would be 100 times better off trying to buy at B, in other words, when the market is going up, as opposed to trying to bottom fish and buy somewhere around A. There's really only one way to make money, obviously, in trading, is to capture a price move. Well, how do you capture a price move? Well, a greater fool must come along and buy the stock from you higher than where you bought it. In reality, we are greater fool hunters. Now, by the way, my approach is short term to intermediate term. On every trade, I go in for a short-term trade, and if it works out, I stick around for a possible longer-term trade, such as the aforementioned ARLP in the portfolio. But initially, I need some greater fools to come along, so at least I get that initial profit target, and hopefully longer-term, more and more greater fools come along. So again, we are really greater fool hunters. So there are only two questions that must be answered before placing the trade. In addition to the other question that we talked about quite a bit on what does this have to do with that? Does it pass the transformer test? But in addition to that question, is there a greater fool out there waiting in the wings? And an even more important question is, am I the greater fool? Now, here's an important thing to remember. The greater fool also believes in the greater fool, okay? So whoever else is out there buying the stock also believes that more greater fools will come along and buy the stock even higher from where they bought it. My mother-in-law occasionally will ask me about buying gold, and she's a bit of a gold bug, which is fine with me because one day, and these are her words, not mine, one day I will inherit it, and I'm okay with that. Anyway, they were over for dinner a few years back, and at that point in time, gold had bottomed out and was beginning to rally and look pretty good. So I told her that gold looked pretty good and she might want to consider nibbling at a little bit of gold. Now, I wasn't talking about buying gold off TV ads. I was talking about buying gold in other ways. And anyway, my father-in-law was very adamant, and he began to pipe up, and he said, "Why would they be selling it to you?" And I'm like, well, the guy's on TV because they probably have a big markup, and he's a businessman who had his business bought out many years ago. So I was like, why does he not understand business? But he kept saying that. Why would they be selling it to? Why would they be selling it to you? And this is how our dinners normally go. We usually end up screaming at each other, but that's another point altogether. But I got to thinking about it, and he had a really good point. If gold was going higher, then why would they be selling it to you? Larry Williams, a while back, made an interesting point. He was talking about gold, and he's talking about the guys on TV. And the guys on TV are telling you how much higher gold is going to go, but they sure do want your dollars for the gold. They want to exchange their gold for your dollars, but gold is going higher. So why would they be selling it to you? Now, where am I going with this? Well, whenever you go to buy a stock, why would they be selling it to you? So add that to your question. So are you the greater fool? Now, in our greater fool hunting, obviously you need to ask yourself, is there a greater fool? Now, how do you find a greater fool? Well, you have a carefully thought out psychology-based setup where the odds are in my favor. Okay, as I said earlier, we're trading traders, not markets. So the TKO comes to mind as one of the simplest patterns that explains the psychology of my way of trading technical analysis. There might be some mumbo jumbo out there when it comes to technical analysis, but unless I can wrap my head around some sort of psychological reason why a particular form of technical analysis works, then I'm going to toss it out. With something like the TKO, you've got a strong trend. You have the trend knockout move, the TKO, which knocks out some nervous Nellies, possibly people that bought around the high. It sucks in some shorts. And if the market begins to take off, you could take advantage of the predicament of those traders. Now, in addition to asking yourself, is there a greater fool? A possibly even better question is, am I the greater fool? And here are a couple things to ask yourself there. Are you trading for action or trading for any reason that has nothing to do with trading? So circle back to, is there a greater fool, and make sure you're picking the best of the best. I want to thank everybody for watching. Again, if you need follow-up information, davelandry.com/stockcharts. If you need to reach me, davelandry.com/contact. So again, thanks for watching, and may the trend be with you.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.